On August 28th, the US stock market hit an all-time high. But within just one short month of that, the market quickly slid down, almost down to 10% at one point, which naturally got people asking, what is the chance of another stock market crash here in 2020? AKA, what is the probability of experiencing a double-dip recession? Now, while it's impossible to foretell the events of the future, it is possible to look at what are some of the more likely events and factors that can contribute to a major stock market crash. That's why in this video, I'm going to look at some of the most quoted financial events that got financial experts worried all over the world and rate them from least likely and least impactful to most likely and most impactful. And if you're worried about how you can prepare for another stock market crash, then I invite you to stick around till the very end of the video because I'm going to give you a list of do's and don'ts that could potentially save your investment portfolio. Now, without further ado, let's jump right in. The first and actually the least likely event to cause a 2020 double-dip recession is actually the upcoming US presidential election. Now, while this YouTube channel will never just explicitly explain the impacts of politics on economics, it is important to understand how politics are somewhat aligned with what's going on in the economy. For instance, if Joe Biden were to win the presidential election, he proposed to increase the corporate tax rate from 21% to 28%. Now, on the other hand, if Donald Trump won the US presidential election, you and I already know that he's rather pro-business and therefore minimal on taxation. However, he is obviously a major aggressor against our number one trading partner, which is China, and therefore that's also going to affect the economy as well. But at the end of the day, I'm not too concerned about either party winning or losing, and that's because the data tells me. Specifically, I'm referring to a report that came out from US Bank, and it quotes like this. The stock market performance after elections. There are a few different variables that can affect the stock market performance. After election, stock market returns tend to be slightly lower for the following year, while bonds tend to outperform slightly after the election. It doesn't seem to make much difference which party takes office, but it does matter whether control of the White House changes hands. When a new party comes into power, the analysts found that stock markets gains on average 5%. When the same president is re-elected, or if one party retains control of the White House, returns were slightly higher at 6.5%. So as you can see from this report, it really doesn't matter which candidate wins, because on average, the stock market is either up 5% or up 6.5% the year after the election. The second and more likely factor to contribute to a double-dip recession in 2020 has everything to do with the concept of vaccines. You see, AstraZeneca recently had to put a temporary pause on one of its COVID-19 vaccines simply because one of its volunteers contracted a very rare autoimmune disease that was caused by taking one of its vaccines. Now, this caused a temporary panic across the marketplace simply because AstraZeneca is a mega biopharmaceutical company, and any large biopharmaceutical companies that's working on a COVID-19 vaccine is obviously going to get a lot of attention on it. And B, this is going to cause further issues because this particular vaccine that AstraZeneca is working on is revolving around the structure of the spike protein, which is related to the virus. Now, because AstraZeneca is not the only biopharmaceutical company that's working around the spike protein vaccine, this may cause ripple effects across those other vaccines and cause further delays. Now, with that background out of the way, here's actually why I'm not too particularly concerned about a vaccine. And the reason for this is simple. This is because actually these starts and stops are actually very commonplace within the biopharmaceutical company. However, there are other reasons around the vaccine that I am particularly worried about. And it really doesn't have to revolve around the concept of when a vaccine is made or even delayed, but rather the implementation of a vaccine. What do I mean by that? Specifically, I want to quote the Gallup poll, which recently showed that 1 out of every 3 Americans will actually refuse to take a COVID-19 vaccine, even if it was freely available to them. Now, then the bigger question is, how do we integrate those people into society who refuse to take the vaccine? And if they refuse to take the vaccine, will there be other parts of the economy that will be perpetually impacted and therefore will never recover? Now, these questions I have absolutely no answers to, but the problem is whenever there are huge looming uncertainties, that usually causes the stock market to be wobbly, if not downright crash. Now let's move on to the third and final factor, which I believe is the most likely factor to contribute to a potential double-dip recession in 2020. And that has everything to do with the fall off of government support. Specifically, I want to list 4 major benefits that's going to be in jeopardy by the end of this year. The first is going to be student loan deferment. Second is going to be eviction protection. Third is going to be mortgage protection. And fourth and finally is going to be unemployment benefits for millions of people. You see, the longer that we're in the stalemate in the political realm, the longer that's going to take for us to dig ourselves out of this economic hole. You see, this is the most concerning to me because we are already at historically high deficit levels, and we have a Congress that is notoriously divided. So whether you or I are using any one of these 4 benefits does not really matter. You see, all of this has implications across the entire economy. So the longer that we're in this stalemate and the less support that we have from our government, the more likely we are to be involved in another major stock market crash. So now that we have identified some factors and events that are least likely to most likely impactful to your stock market portfolio, let's look at a list of do's and don'ts that could potentially save your stock portfolio. The first do's and don'ts is don't panic even if there's a market crash. Instead, create yourself a financial cushion. So what do I mean by financial cushion? Well, imagine that you have an emergency fund that's roughly 3 months worth of living expenses. You want to increase that buffer in case of uncertainty. So instead of 3 months worth of living expenses, you'll have 6 months. And if you have 6 months worth of living expenses, consider extending that to either 9 months or even a full year. For me, I personally do this because it buys me a peace of mind. And even if there is a huge amounts of income that's getting affected by a pending recession, then I know that I at least have some breathing room so I can think before I panic into doing something silly. The second list of do's and don'ts is don't keep an excess amount of cash outside of your emergency fund. Instead, every single dollar that is outside of your emergency fund should be put into work, especially into investments. And the reason for that is actually simple to understand. And that's because currently our Federal Reserve has printed trillions of dollars, which is quickly devaluing our currency like crazy. And so the more that you sit on your cash, say for instance in your bank account, which yields less than 0.1%, the more that your money gets devalued, aka the more money it takes for you to buy the same amount of goods even a year out from now. Now, this list of do's and don'ts pertains to those who are already investing and already have their emergency fund built out. And that is, don't solely invest in stocks, but do diversify your investment portfolio with other asset classes like bonds, real estate, and maybe even some gold. And the reason for portfolio diversification is really easy to understand. In case the stock market crashes, there are generally other asset classes like bonds and gold that would go up in case the stock market goes down. So overall, diversification will mitigate your risk while still growing your portfolio over the long run. Now, in case you don't know how to start diversifying your portfolio outside of stocks, I would highly recommend you download my step-by-step guide on how to manage and grow your own investment portfolio through other asset classes as well. That link is in the description below. If, however, you're one of those people who are sitting on a good amount of cash or 100% in stocks, but you just don't have the time or the resources to sift through thousands of articles and YouTube channels, then consider hiring me as your investment coach, where I distill down my 25,000 plus hours worth of Wall Street experience down to only 6 hours worth of highly actionable financial knowledge. So there you have it, guys. Hopefully you found this video helpful. If you did, please hit that like, subscribe, and that notification bell for more videos like this. Until next time, my name is Peter, and I hope you stay safe and stay invested, my friend.